In this video, we're going to walk through the details of the manufacturing cost flow system, and afterwards we should understand how materials, labor, and overhead costs are added to product at each stage of our production process. All of our product costs are recorded in inventory when the costs are incurred. And a manufacturing company has three different types of inventory accounts. Raw materials inventory, that's what we're purchasing to make the product. We have work in process, and that's the products that are currently being made. They're in the manufacturing process but not yet completed. And then, of course, we have finished goods inventory. Those are the products that have finished the manufacturing production process but we have not yet sold. Let's look a little bit more closely at each one of those individual accounts. If we looked at our direct material inventory account, we see we would have beginning inventory. We would add to that purchases, given goods available for production. And then, of course, it's either left in ending raw materials inventory or we've transferred it to work in process. Let's take a look at that a little bit more closely on a cost flow diagram. If we have beginning inventory of $1,000, we make purchases of $6,000. That gives us $7,000 available for production. And we're going to need to make sure we account for that full $7,000. So it needs to either be transferred to work in process or left in ending work in process. If we transfer $5,000 to work in process, that means our ending raw materials inventory should be $2,000. One of the nice things I like about this diagram is that it forms a natural T account. Assets have a beginning balance on the left-hand side of a T account. We record purchases with debits to raw materials, and of course, as raw materials go down, we would take them out of raw materials with a credit. So our flows will line up nicely with the T accounts in our cost flow diagram. So our direct materials then are transferred into work in process, and then of course from work in process, goods are transferred to finished goods. Let's look at both of those in a bit more detail. Let's assume that we have $2,000 beginning work in process, and if you recall, we transferred in $5,000 from raw materials inventory. We would also include direct labor, would increase work in process, and then of course we have applied manufacturing overhead. So we have our three inputs: direct materials, direct labor, and applied overhead. And that would give us an ending balance in work in process of $17,000. And we're going to need to account for all that. So I'm going to put $17,000 on the other side. And it's either left in ending work in process or it has been completed and is transferred to finished goods inventory. If we have a beginning balance in finished goods of $5,000 and we transferred in, we had cost of goods manufactured of $15,000, that'll give us goods available for sale of $20,000. And of course, we'll need to account for the full thing. And if we've got $3,000 left in ending finished goods inventory, that means our cost of goods sold for the period had to be $17,000. And of course, our cost of goods sold gets transferred to the income statement. Let's walk through a short problem. We're given information regarding beginning balances in our raw materials work in process, as well as in finished goods, as well as ending balances. Let's go ahead and put those on our cost flow diagram. The beginning raw materials balance is $1,500. The beginning work in process balance is $7,600. And the beginning finished goods balance is $8,700. We're given information regarding the ending balance. Ending balance for raw materials is $2,000. Ending balance for work in process is $6,800. And ending finished goods is $10,300. We're also given some information regarding some costs that were incurred during the period. And let's see how these would show up on our cost flow diagram as well as our income statement. Remember, we have both product cost and period costs. Our first cost is the $3,000 in administrative cost. Our journal entry would be to debit administrative expense, credit cash, and of course, period costs flow directly to our income statement. Our next cost is for, we're told, applied manufacturing overhead. Recall, we both incur manufacturing overhead and we apply it to production. So the applied manufacturing overhead is debited to manufacturing, or rather credited to manufacturing overhead, and it goes into work in process with a debit. And we can see that's on the left-hand side of the T account for the debit, and it's on the right-hand side of the T account for the credit. Our next cost is our depreciation on the factory. Normally, for depreciation expense, we would debit depreciation expense and, of course, credit accumulated depreciation. But since this is depreciation on the factory, it's part of manufacturing overhead. So we will debit manufacturing overhead, and of course, that is an actual cost that we've incurred of $2,700. So we will record it on the left-hand side, or the debit side of our T account for manufacturing overhead, our actual manufacturing overhead. Next, we're told we have $4,600 in depreciation on our machines. Of course, that will be a debit to manufacturing overhead and a credit to accumulated depreciation. And in terms of our T account for manufacturing overhead, the debit would have increased it. Again, we record actual manufacturing overhead on the left and our applied manufacturing overhead on the right, the credit side. Our next cost is direct labor, $26,500. Normally we would debit payroll expense, but since this is direct labor in our factory, it goes directly into work in process. So we'll debit work in process for $26,500. We would have, of course, credited wages payable or cash for $26,500, and we see that $26,500 show up under work in process, an increase to work in process. The next cost we're asked to consider are raw materials that we've purchased. Our raw materials purchased will be a debit to raw materials inventory and a credit to accounts payable. And of course, that is an increase to our raw material T account, and we record that again. Debits recorded on the left-hand side. Next, we have indirect labor. And again, indirect labor, examples of that would be the factory supervisor, maintenance people in the factory, janitors, security staff, anyone who's not working directly on the product, but yet is working in the factory, would be considered indirect labor. And that indirect labor is part of manufacturing overhead, and of course we would credit wages payable, or in this case cash. So we have another increase to our actual manufacturing overhead. Our next cost are property taxes on the factory. And again, the key word is factory. So it is a manufacturing overhead. And we will debit manufacturing overhead and credit cash or some sort of payable. And again, that was an increase. It's recorded on the left-hand side of our T account in our cost flow diagram. Next, we have selling cost, $1,300. Selling costs are a period expense, and they're going to appear directly in our income statement. So we debit selling expense and the credit payable or cash. And again, that will go on our income statement, $1,300 for our journal entry. Next, we have sales revenue of $61,000, and we would debit accounts receivable, credit sales revenue, and of course that shows up on our income statement as well. Finally, we have utilities on the factory, and again the key word is factory, so it's manufacturing overhead. We're going to debit manufacturing overhead, and we'll credit accounts payable or cash, and again that's an increase on the left-hand side of our T account for manufacturing overhead. If we add up our total manufacturing overhead, our actual was $9,600, and yet you can see we applied $10,000. So we're going to have over-applied manufacturing overhead, and we'll get back and talk about that in just a bit. Let's go ahead and figure out some of our missing items on our cost flow diagram. Let's begin by taking a look at raw materials. We have a beginning balance of $1,500. We purchased $15,200. which gives us $16,700 available. We need to account for the full thing. So how do we account for the $16,700? If we had $2,000 in ending inventory, that means we had to have used $14,700. And of course, these are all direct materials, so they go directly into work in process. Now we can calculate our total work in process. We're going to take our current costs, which include materials, labor, and overhead, add that to our beginning work in process, and we've got $58,800 in cost on our shop floor that we need to account for. If we've got $6,800 left over, that means we must have moved $52,000 off the floor. So we manufactured $52,000 worth of goods, and that of course flows into finished goods. Beginning finished goods of $8,700 plus the 52 gives us $60,700 available for sale. And again, we'll account for that whole thing. So the right-hand side has to equal the left-hand side. If we've got $10,300 left over, that means our cost of goods sold had to be $50,400, and that of course moves directly to the income statement. Sales then minus cost of goods sold gives us a gross profit of $10,600. And I'm going to put that right over here for just a second, because we're going to need to talk about how this $10,600 might change. One of the things we noticed was we actually incurred $9,600 in overhead, but we had charged $10,000 to work in process. And if work in process is too high by 400, that means of course our finished goods has to be too high by 400, which means of course our cost of goods sold has to be too high by 400, which means our gross profit has to be too high by 400. So what we're really going to do is we want to reduce our cost of goods sold. So we reduce our cost of goods sold by $400. So instead of $50,400 in cost of goods sold, we really only had $50,000 in cost of goods sold, which of course makes our gross profit go up. And I should have put that as a minus 400. So cost of goods sold, instead of being $50,400, it's really only $50,000. And if we take the $61,000 minus $50,000, that would have given us our gross profit of $11,000. So we see if we've got too much in applied overhead, it will make our work in process too high, it will make our finished goods too high, and ultimately it will make our cost of goods sold too high. And hopefully you remember from managerial accounting, at the end of the period, we need to close out our manufacturing overhead account. And right now we have 10,000 in credits, 9,600 in debits. So to zero or close this out, we would have needed another $400 debit to manufacturing overhead. We debit manufacturing overhead, and we credit cost of goods sold, which is exactly what we were saying. We were saying that work in process was too high, finished goods was too high, and cost of goods sold was too high. And with that $400 credit to cost of goods sold, we have reduced cost of goods sold. So this was a situation where we had over-applied overhead. We could have had a situation where we had under-applied manufacturing overhead. Let's consider an extreme example where we have nothing for applied manufacturing overhead. Well, that's going to make work in process too low by 10,000, which of course will make finished goods too low, which of course will make cost of goods too low, which will then of course make our gross profit and net income too high. So in the event that we did have under-applied manufacturing overhead, in this case we would need a $9,600 credit to manufacturing overhead. So credit to manufacturing overhead, $9,600. And we would, of course, would debit cost of goods sold for $9,600. And when we debit cost of goods sold for $9,600, we've increased cost of goods sold, and we've gotten back to where we should be with our gross profit. So again, we close out any under or over applied manufacturing overhead directly to cost of goods sold. Later on in the course, we'll consider closing out perhaps part of it to work in process or part of it to finished goods. But the key thing to remember is if we apply too much manufacturing overhead, work in process is too high, finished goods is too high, which will make netting our cost of goods sold too high.